The Federal Reserve initiated the most reckless, foolish set of measures in the last century with their quantitative easing policy, even after it was stated that QE basically didn't work as they expected it to. They still engaged in 3 rounds plus Operation Twist. In December 2015, the Federal Reserve finally began to increase interest rates from the lowest level ever in history. Here we are 3 years later and it's still near historic lows. The Fed still has over $4 trillion worth of printed fiat garbage sitting in its digital fiction fairy tale balance sheets, rotting and destroying the value of every American saver. This institution is doing a major disservice to everyone in the United States, and it should be immediately abolished by the Congress for its ceaseless attack on the public. Instead, what will happen is that the media will praise their actions. Ben Bernanke on the cover of the Atlantic magazine as a hero will remain a reality for so many people, and people will beg and plead for the Fed to save the day once again. You came here for the truth, so let me unveil that for you. That was one hell of an introduction. I have an absolutely jam-packed episode for you today. I have so much information to get into. It's going to make your head spin. Take a seat. Don't get dizzy. Let's begin by taking a look at the markets. This is a breakdown of what happened on Tuesday's trading session, a day before the Federal Reserve meets and decides will they be increasing interest rates or will they stay put. And you can see all of the markets for the US had remained in the green. It was up significantly on the day, but then had come down quite a bit. You can see the Dow Jones happened to be up 82 points on the day. However, at one point throughout the day, I saw it over 200 points and possibly even beyond that. We are still looking at the Dow Jones being under 24,000. It's a significant number, not just for what occurred specifically over the last few trading sessions, but in general, that psychological 24,000 level has been very important. Let's take a look at this quote here. I think it's anxiety about slowing economic growth, and traders want assurance that someone's going to do something. And that's the way this market lives. It is relying on the support of that someone, and that's the Federal Reserve, or maybe the government with another TARP type bailout. It can't be sustained on its own. We need someone to do something. And that really sets the tone for the rest of this video. I'm just going to go rapid fire. There's too much to cover today. This right here is showing us the red line, which is the S&P 500. It is down 12.25% as of yesterday's trading session, but it just shows you that they have all come down from their peak here that was experienced at the end of September into October with all the other markets. They started weakening further and further and further. S&P 500 December to date performance, the worst experience since 1931. December is usually a time in which we see positivity. That didn't happen this time around, but it was widely expected to be a good December, and things have really looked terrible. Degree of monetary tightening from 1960 up until present day. What's interesting here is that it's a little different than in the past because we have the quantitative easing policy. What they're showing you with the green line in this case is the shadow Fed funds rate. And that basically is the effect of the quantitative easing being essentially like reducing interest rates. So it was stated that the effect of that quantitative easing was as if they brought interest rates down to -3%. I've shown you this chart before, but basically what you're looking at right now is the fact that they have actually, if you include that, tightened quite a bit here. That's what this chart tells us. I think it's very important to look at this, understand the effect of the quantitative tightening policy that is taking place today when you factor in the amount, which is still very small, the amount of money that they've pulled off of their balance sheet, as well as the interest rate hikes together, they have actually gone to a level where historically this would be it. So we are at that point today, coincidentally, right now in December of 2018, looking to be already restrictive in their monetary policy. Ridiculous to say the least, but that's where we're at. You can see this, the blue line, being the Fed's balance sheet. They kept it there for years, an absolutely ridiculous policy if you ask me, but it happens to coincide entirely with the S&P 500. You'll see that as soon as they stopped supporting it, as soon as other central banks stopped printing and started to reduce their quantitative easing policies, the market started to act very wildly, and that's what you get. You have turmoil, and this unfortunately is not going to be resolved unless the Federal Reserve enters into QE4, and we'll see what happens with that. Profit expectations have obviously diminished right now throughout 2018 as expected. You're looking at the European markets right here, whether it's Germany, whether we're looking at Italy, these two markets have suffered, but you can basically look everywhere right now today in 2018. It has not done very good at all. And what's interesting is that right now 90% of assets are poised to have a negative return throughout 2018, one of the worst years on record. Global equities had a relatively large and fast correction. MSCI World Equity Performance 10% corrections and 20% bear market since the 1970. And we're just comparing the current, which is the orange, and then you can see the average corrections. That's the light blue line, and the dark blue line is the average bear markets. So we'll see where we end up, and I'm really curious to see how the markets react to tomorrow's meeting of the Fed. I'm really anxious to get that information out. So if you're watching this after the Fed meeting, let's talk about that as well. I will cover it absolutely. In every major market shock since the 2013 taper tantrum, central banks have stepped in, even if verbally, to protect markets. Following the Brexit vote, markets no longer needed to hear from central banks as they rebounded so quickly that central banks didn't need to respond. Buy the dip has become a self-fulfilling put, except in 2018. That's very telling right now. The Federal Reserve would come in, the other central banks would come in, print up some money, or they would tell the market, don't worry, we're going to come in and we will protect it if it falls down a little bit more. We'll be there to backstop any losses. They were doing that. Now something has changed in 2018 ever since the VIX had its issue at the end of January that caused a big problem for global markets. Seems unusual, but that's what happened. All right, then we're looking at algorithms. This is unbelievable. The amount of money that's being traded by algorithms today is absurd. Algorithmic trading has grown across asset classes. Market share of algorithmic trading by asset class percentage at the top of the list, equities nearing 70%. I've seen much higher numbers. I'm sure this is on a global level. If we look at this, it doesn't necessarily break that down, but I'd like to know exactly the number on a average. Of course, it depends, I'm sure, on the month or the day or so on. Regardless, then you're looking at the futures at about 50% and so on. It goes down the list on the right-hand side, and regions, though the US still leads the way. And you could see the market share, the US being nearly 70% in this case. Europe seems to be at about 45 or so. The US obviously leading the pack in this regard, and it's very dangerous. That means that in the next recession, we are going to have major issues because of the algorithms. Very worrisome, not a good thing at all. It makes it easy for them to make a profit on the way up, there's no doubt about that, but on the way down, there's going to be panic selling, and they're going to have to halt trading many times because of this. Algorithmic trading has become more popular across products within futures markets, and you could just see commodities, dairy, grain, livestock, lumber, and so on. It just goes through all of that. You know, if I were to roughly guess, it's probably around 50% in all of these different markets. That's dangerous. All right, now, one of those most important commodities that I always want to touch on when I can is oil. WTI crude has fallen to $46 $88.71 right now as of Tuesday evening when I record this. Brent crude is at about 56. That shows us the weakness that has been experienced not just in oil but other markets as well. There's a lot of talk about why this is happening. They're always telling us there's a glut of oil. Then the price will go up by $5. What happened to the glut? Did it disappear? No, it's just business as usual. Let's bring the price up. Let's make sure that people are still paying too much for their gasoline. Let's screw people over on this and that. Let's close some refineries. Let's make sure that we're making a handsome profit off of this. Let's move on to this chart showing us the number of ounces of silver to buy a barrel of WTI. This is something interesting, not just this particular chart, of course, but when you measure something in something else, then it gives you an entirely different perspective on it. If we're always pricing everything in US dollar, yes, that's great for consistency purposes. But if you start to measure it in, as they're doing here, a barrel of oil, measuring it in silver, measure it in gold, measure it in wheat, measure it in one share of the Dow, and so on, you start to look at things very, very differently. Mike Maloney does this often, and I just really like it because it just to change my perspective entirely about what I'm looking at any given time. This just shows us that throughout the recent months, this number has really fallen down, 3.16 in this case here, number of ounces of silver to buy a barrel of oil. The 50 stocks that matter most to hedge funds. And guess what's on the top of the list? I know the font is extremely small. Microsoft, Amazon, Facebook, Alphabet, and then we have Alibaba next in that line here. There's also Visa and PayPal. Apple is down this list as well, and all of the big names that you would see, Citigroup and T-Mobile and Bank of America and Netflix, and they're all in here as well. But these are the stocks that everybody is buying. The hedge funds are buying them. The central banks are buying them. The individuals, the retail, the 7-share of Amazon type investors are buying them. The ham sandwich type investors are buying them as well. Looking at this here, evolution of the global FMS most crowded trade. This is something that I cover consistently, and it is very important to track it on a month-to-month basis to see what the individual investors are doing. And long US dollar has now beaten up the FANG stocks, or more specifically, long FANG and the BAT trade. That was for the longest period of time, all throughout 2018, up until just now. So December, that had changed. As of the last one, November, we saw that that was still the case, but it has right now just changed to be a long US dollar, meaning they want to be safe and secure. The last time this was the major trade was in April 2017. Looking at the biggest tail risk, still month after month after month, the trade issues are on the top of the list. We'll see what happens if they increase interest rates, tomorrow as of this recording. If they do increase interest rates, I'm curious, very curious to see how this will change. Looking at this next chart, what do you consider the biggest tail risk? Just showing us the comparison between December and November, and the trade issues are pushing in front here, definitely being the primary issue that people are looking at today. This is the biggest tail risk. Okay, we have that. What do you think is the most crowded trade? Looking at this information, long US dollar beating out all of the rest in this case from December in comparison to November. All right, now quickly, Alan Greenspan literally said, run for cover, okay, very quickly. He talked about the irrational exuberance. Everybody knows about that. He was actually ridiculed at the time, later on proved to be correct. It would be very surprising to see it sort of stabilize here and then take off. He added that the markets could still go up further, but warned investors that the correction would be painful. Quote, at the end of that run for cover. That's Alan Greenspan. If you read his book, Age of Turbulence, I believe that's the title, it's basically his own biography about his entire life before the Federal Reserve, during the Federal Reserve, and afterwards. And I really think that people should read it, although you might agree with some of it, you might disagree with some of it. It's great to get the mind of such a powerful individual into a book and learn from it, learn what he was going through. It's funny because you read what he was into before. He sounds very libertarian before becoming part part of the Fed. And then he becomes the Fed and he completely sold out while he was at the Fed for that long duration. And then afterwards, he's starting to talk more into that libertarian mindset. Very interesting. He just, for that time, he just completely sold out and whatever. But he actually makes very good points. And that's the reason why I want to talk about him when I can. I don't necessarily have to agree with anything the gentleman says. I just basically look at what individuals are bringing together and I take pieces from everybody. And that's what I like to do. And one individual who has been very vocal recently is Jeffrey Gundlach. I probably butchered his name, but you know who I'm talking about. And he was just quoted and maybe one or two sentences was taken from the interview that he did, but you should check out the actual interview for yourself. So if you want to look it up, the link is in the description under the sources, or you can just type in Gundlach, the Fed should not raise rates this week from CNBC. And you could see he quotes everything, the reason why it's wrong, the reason why the Federal Reserve messed up initially, not just what they're doing now as a policy. He talks about all the issues and it is only 7 minutes long and you learn a lot in that short period of time. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. I work very hard to put these videos together. All I ask is that you give me a thumbs up. If you could comment, if you could subscribe, that's great as well. Thank you very much. Last but not least, if you want the financial education you were not taught in school, these two books have it all. I jam-packed these books into such a readable and easy format. I assure you that you will love them. Definitely check them out. The link in the description if you want the audiobook that's available at themoneygps.com.